Mike and Rachel Donovan are sitting across from a mortgage broker who's just told them something that doesn't make sense. Their house, the one asset they own outright pride in, worth more on paper than everything else they own combined, would cost them money to sell. Not make them money. Cost them, out of pocket, just to walk away from it. "We have equity," Mike says, leaning forward like he might have misheard her. "How does having equity mean we'd lose money?" Rachel doesn't say anything. She's already doing the math again in her head, the same math she's been doing at the kitchen table for the last 3 months, hoping it would come out differently this time. By the end of this story, you'll understand exactly how that's possible, and why it's currently happening to millions of American homeowners who did everything they were told was responsible, in exactly the order they were told to do it, from people who genuinely believed a house was the safest financial decision they'd ever make. You'll also understand the 3 numbers almost nobody checks before buying, the ones that actually determine whether a house builds wealth or quietly drains it for years without anyone noticing until it's too late to fix cheaply. I'm Ryan, and this is Wealth Maps, where we learn real financial lessons through the stories of ordinary people. Let's go back to where this one actually started. For years earlier, Mike and Rachel got pre-approved for $420,000 and treated that number the way most first-time buyers do, not as a ceiling, but as a green light. They'd sat in a different office, a loan officer sliding a piece of paper across the desk with a number on it that felt, in the moment, like a verdict on their own responsibility. If the bank was willing to lend it, the logic went, the bank must have already done the math on whether they could afford it. Why else would a bank, of all institutions, take that kind of risk on them? Here's the first thing almost nobody explains clearly enough, and it's worth pausing on, because it's the root of everything that happens next in this story. A pre-approval measures whether you can make payments on paper, based on income and existing debt, at the moment you apply. It says nothing about property taxes rising, insurance premiums climbing, a roof needing replacement, or a single dollar of the maintenance costs that come with owning instead of renting. The bank isn't lying to you. It's just answering a much narrower question than the one you're actually asking, and nobody ever tells first-time buyers those are 2 different questions at all. Mike and Rachel bought a house at $395,000, close to their ceiling, with the kind of starter home optimism that assumes a starter home stays exactly as expensive as the day you sign for it. They picked out paint colors together their first weekend as owners, genuinely happy, genuinely proud, doing exactly what they'd been told responsible young adults were supposed to do. It didn't stay that price. Nothing about owning a house ever does. Property taxes get reassessed periodically, tied to rising home values in the area, which sounds like good news, right up until you realize the tax bill rises with it whether or not your income does, whether or not you asked for your house to become more valuable, whether or not that value means anything real to you at all until the day you actually sell. The Donovans' property tax bill climbed by $1,100 over 3 years, an increase that showed up in small pieces, easy to absorb individually, brutal to add up all at once when Rachel finally sat down one night with 3 years of statements spread across the kitchen table. Then came the insurance letter, sitting in a stack of mail Rachel almost didn't open that Tuesday, wedged between a grocery flyer and a birthday card. Home insurance premiums have climbed nationally by nearly 47% since 2020, according to recent industry data, driven by more frequent severe weather, rising repair and material costs, and insurers recalculating risk zone by zone, state by state, sometimes street by street. The Donovans' premium alone jumped $600 in a single renewal cycle. 71% of American homeowners report their insurance costs have gone up in recent years. 42% say it went up a lot. Mike and Rachel were solidly in that second group, and neither number had anything to do with a single decision either of them had made, not a claim filed, not a late payment, nothing they could point to and call a mistake. Ask yourself, when you last budgeted for a house, Did you build in a line item for insurance premium increases 3 years from now? Almost nobody does, because almost nobody is ever told to. There was a second charge buried in their monthly statement that took Mike nearly 2 years to actually understand. Private mortgage insurance, added automatically because their down payment had been under 20%, a monthly fee protecting the lender, not them, that most first-time buyers don't realize they're paying until they specifically go looking for it, and one that doesn't disappear on its own until the loan balance drops low enough for someone to request it be removed. Nobody had ever told Mike he could ask. He found out, eventually, from a coworker mentioning it offhand at lunch, and spent the entire drive home that day doing quiet math on how many months of a charge he hadn't known was negotiable had already gone by. Then the water heater failed, on a Sunday, the worst possible day for anything to fail. $1,400, cash, immediately, the kind of expense that doesn't wait for a good month to happen in and doesn't care that the insurance renewal had landed 3 weeks earlier. None of these, on their own, would have been the story. Property taxes rise everywhere. Insurance rises everywhere. Water heaters fail on their own schedule, indifferent to anyone's budget. What made this a trap instead of just an inconvenience was what all three were quietly doing to the Donovans' monthly cash flow at the exact same time, stacking on top of a mortgage payment that had never once changed, on top of a PMI charge Mike hadn't known to question. This is what economists call being cost-burdened, spending more than 30% of your income on housing, a federal standard that's been used to measure affordability stress since 1981. Roughly 24% of American homeowners currently meet that definition, over 21 million households, and the number climbs every single year even among people who technically own their home outright, no mortgage at all, because taxes and insurance don't care whether the loan is paid off. Homeowners without a mortgage have actually seen their costs rise faster, proportionally, than those still paying one, driven almost entirely by exactly the two line items the Donovans were drowning in. Mike and Rachel weren't behind on a single payment. They just stopped being able to save anything at all, month over month, the exact opposite of what a house is supposed to be doing for a family's finances. Rachel started keeping the grocery receipts in a drawer instead of throwing them away, comparing them week to week, looking for a leak that wasn't actually in the groceries at all. That's when Rachel suggested selling, moving somewhere smaller, resetting the whole equation. Mike resisted at first, not because he disagreed, but because saying yes felt like admitting out loud what they'd both been avoiding saying to each other for months. That's the conversation that led them to the mortgage broker's office, and the number that didn't make sense. Here's the part of the trap almost nobody sees coming until they're sitting exactly where the Donovans were sitting. Selling a home typically costs 5 to 6% in realtor commissions alone, plus closing costs, transfer taxes, and whatever repairs and inspection turns up before a buyer will actually sign, costs that exist whether the sale is voluntary or forced, whether it's a dream move or a desperate one. On a house now worth $440,000, that's over $26,000 in selling costs before a single dollar reaches their pocket. Subtract what they still owed on the mortgage, still hovering close to where they'd started given how little of an early payment actually goes toward principal, and their equity sitting on paper wasn't nearly enough to cover both the payoff and the cost of leaving. They weren't underwater, technically. They were something almost worse, technically wealthy, congratulated at every dinner party for their smart timing on the housing market, and unable to actually access a dollar of it without going into debt to do so. That was its own particular kind of pressure, one nobody talks about in these conversations. Rachel's sister had bought a smaller condo the same year and rented it out, casually mentioning at every holiday how much the market had done for her. Mike's co-workers assumed, the way people always do about a homeowner, that he was doing fine, better than fine, sitting on an asset most of them were still saving toward. Neither Mike nor Rachel ever corrected anyone. Admitting the truth felt, somehow, like admitting they'd failed at the one financial milestone everyone around them had already decided they'd succeeded at. "So we can't afford to stay," Rachel said, in the broker's office, voice flat in a way Mike had never heard from her before, "and we can't afford to leave either." That sentence is the entire trap, said out loud, and it's the sentence millions of American homeowners are currently living inside without ever having said it to anyone, sitting in houses that look, from the street, exactly like success. The broker didn't have a magic fix, because there rarely is one. What she had instead was a different way to look at the math than the Donovans had ever been shown, pulling out a blank sheet instead of another form. She walked them through their actual cost of ownership, not the mortgage payment alone, but principal, interest, taxes, and insurance combined, the number lenders call PITI, the real number that should have anchored their budget from day one instead of the loan amount alone. Mike sat there doing the math he should have been shown 4 years earlier, and felt something between relief and quiet anger that nobody had ever handed him this exact worksheet at the closing table. She helped them refinance into a lower rate that had become available since their purchase, trimming the payment enough to breathe. She helped Mike file the paperwork to finally drop the PMI charge, since their payments had quietly built enough equity to qualify without him ever knowing to ask, a 5-minute form that immediately put another $110 back into their monthly budget. She connected them with a HUD-approved housing counselor, free of charge, who helped them build an actual maintenance reserve, a specific, separate account funded monthly, sized to the age and condition of their specific house, calculated using the age of the roof, the furnace, the water heater's replacement, instead of hoping the next surprise repair would somehow be smaller than the last one. The counselor's rule of thumb was simple enough that Mike wrote it on a sticky note and kept it on the fridge: budget roughly 1 to 2% of the home's value every year for maintenance and repairs, set aside automatically, treated exactly like a bill instead of an emergency whenever it finally arrives. Nobody had ever told him that number existed either, in 4 years of home ownership and 2 years of renting before that. The counselor asked them one question neither had ever been asked before, by anyone, at any point in the process of buying: what's the actual age of everything in this house that's going to eventually break? Neither Mike nor Rachel had a complete answer. They do now. It's written on an index card taped inside a kitchen cabinet, next to the reserve account's login information. They didn't sell. They didn't need to, once the actual number in front of them included everything it should have included from the beginning. 18 months later, the maintenance reserve has covered 2 repairs without touching a credit card, a furnace igniter, a cracked section of fence after a storm, both handled the same week they happened instead of triggering the familiar scramble. The insurance premium went up again this year, right on schedule, part of a national pattern that shows no real sign of slowing. And for the first time, it didn't feel like an emergency, because it was already accounted for months before the letter arrived, sitting in a line item instead of landing like an ambush. Mike still thinks about that afternoon in the broker's office more than he expected to. Not because it was the worst afternoon of his financial life. Because it was the first time anyone had ever shown him the entire cost of the house he already owned, instead of just the one number the bank had approved for years earlier, standing in a different office, feeling like the number itself was a kind of verdict on how responsible he was, how ready he was to be an adult who owned things. It wasn't a verdict. It was never even the whole question, and nobody at that first closing table had any real incentive to make sure he understood the difference. The house was never actually the trap. The trap was believing that a single approved number, at the very beginning, was the whole story, instead of the opening line of a much longer one that kept adding chapters nobody had warned them to expect. Taxes that rise on their own schedule. Insurance that rises on a schedule set somewhere else entirely, in boardrooms neither Mike nor Rachel will ever sit in. A fee like PMI that sits quietly on a statement until someone finally asks the right question about it. Repairs that arrive precisely when the budget has the least room for them. None of it announced itself as a trap in the beginning. It just quietly became one reasonable, unremarkable bill at a time, exactly the way it's currently happening in millions of houses that look, from the street, exactly like success. So here's a question worth answering honestly in the comments below. When you bought, or if you're planning to, did anyone ever walk you through the real number, taxes, insurance, maintenance, all of it, or just the one the bank approved?